Something happened in the markets this week that most people are going to misread completely. Gold, one of the most sought-after assets in human history, just touched its lowest price since last November. Silver has been cut almost in half from where it was just 5 months ago. And Bitcoin, which was riding an extraordinary wave not long ago, is now trading more than 50% below its all-time high set less than a year ago. If you are watching financial news right now, the coverage is going to make you feel like the world is ending. But before we talk about what this means, I want to ask you something important. What if the single most expensive mistake an investor can make is not buying at the top, not panic selling at the bottom, but rather not understanding the difference between the two? What if the fear that feels so real and so rational right now is actually the most predictable thing in markets, recurring again and again throughout history, looking exactly the same every single time it appears? And what if the people who are scared right now are looking at the same type of moment that, in every prior cycle, turned out to be the setup for something significant? That is what we are going to unpack today. Not noise, not hype, history, mechanism, and fact. Let us start with the actual numbers, because numbers without context are just anxiety in disguise. As of late June 2026, gold is trading around $4,000 per ounce. That sounds like a lot, until you remember where gold was in January of this year. On January 28, 2026, gold hit an all-time high of approximately $5,589 per ounce. That was an extraordinary, historic number. At that moment, gold had gained more than 60% in a single year, the best annual performance since 1979. From that January peak to where we sit today, gold has fallen roughly 27%. Now think about what that means in real terms. If someone invested $100,000 into gold at the peak in January, that same position is worth approximately $73,000 today. That is a real paper loss, and it feels real. It is uncomfortable. It creates doubt. But here is the critical question. Does a 27% correction tell us that gold is broken, or does it tell us something else entirely? Before we answer that, let us look at silver, because silver's story is even more dramatic. Silver hit an all-time high of approximately $121.60 per ounce on January 29, 2026. That was a staggering moment, the first time silver had ever broken the psychologically significant $100 mark in its entire history. 5 months later, silver is trading around $59 per ounce. That is a decline of just over 50%, half the value, gone, in 5 months. And Bitcoin? Bitcoin set its own all-time high of approximately $126,000 per coin in October 2025. As of late June 2026, Bitcoin has traded near the $60,000 level, down more than 50% from that peak. So we have 3 major assets, all down dramatically from recent highs, all generating fear, all generating negative headlines. But here's what the headlines are not explaining, and this is where things get genuinely interesting. The reason these assets fell is not what most people think it is. This is the part I want you to really pay attention to, because understanding the mechanism behind a move changes everything about how you interpret it. Most financial commentary right now is saying things like selling pressure or weak demand or risk-off sentiment. These phrases describe what happened on a screen. They do not explain why it happened in the real world. So let us trace the actual cause. It begins with the Federal Reserve and a concept called real yields. The Federal Reserve held its policy meeting in mid-June 2026. The new Fed chair, Kevin Warsh, made the messaging unmistakably clear. Inflation is still running too hot. The headline Personal Consumption Expenditures measure, which is the Fed's preferred inflation gauge, came in at 4.1% year over year in May. That number is more than double the Fed's stated 2% target. Rate cuts are not coming. In fact, markets have started pricing in the real possibility of additional rate hikes, with some estimates showing roughly a 60% probability of an increase in September. Now here is what that means for gold and silver specifically. Gold produces no yield. It pays no interest. It pays no dividend. It simply holds its value over time. Silver has some industrial demand behind it, but in the monetary sense, it also pays nothing to hold it. So when the Fed signals that interest rates will stay high or potentially go higher, something called real yields rise. Real yields are essentially the inflation-adjusted return you can earn from safe government bonds. When you can park money in a U.S. Treasury and earn a meaningful return after inflation, the question naturally arises: why hold an asset that pays you nothing? This is what economists call the opportunity cost of gold. When that opportunity cost rises, capital flows away from gold and toward yield-bearing instruments. And when capital leaves, price falls. There is a second mechanism working alongside this one. Higher interest rates make the US dollar stronger. Global investors sell other currencies and purchase dollars to access those higher yields. And because gold, silver, and most commodities are priced globally in dollars, a stronger dollar makes them more expensive for international buyers. Less international demand means downward price pressure. This chain, from hawkish Fed language to rising real yields to a stronger dollar to falling precious metals, is not a theory. It is the documented, verified mechanism that has moved these markets in every single rate cycle in modern financial history. And in June 2026, it played out exactly as it always has. But here is what makes this moment genuinely compelling. And this is the part most people watching financial news are completely missing. While short-term macro forces like Fed policy are pushing precious metals lower, the structural, long-term story for gold and silver has not changed even slightly. In fact, in some important ways, it has strengthened. Let me give you the specific data. According to the Silver Institute's World Silver Survey published in April 2026, the global silver market is heading into its sixth consecutive year of structural supply deficit. What that means in plain language is that the world is consuming more silver than it is producing, and this has now been true every single year since 2021. The projected shortfall for 2026 alone is approximately 46.3 million ounces, up 15% from the prior year. Since 2021, the world has drawn down above-ground silver reserves by an estimated 762 million troy ounces to cover these deficits. That is roughly equivalent to an entire year of global mine production, just evaporated from existing stockpiles over 5 years. And where is this silver demand coming from? Solar panels consume significant silver in their photovoltaic cells. Electric vehicles use silver throughout battery management and electrical systems. Semiconductors, medical devices, defense technology, and artificial intelligence infrastructure all require silver. The Silver Institute projects that these technology sectors alone will continue driving industrial demand higher through at least 2030. Here is the critical point. This industrial demand is not going away because the Fed raised rates. It does not slow down because the dollar is strong. It is structural. It is tied to the actual physical build-out of the global economy. Short-term macro forces can overpower structural fundamentals in the near term. We are seeing that right now. But over longer periods, fundamentals always reassert themselves. That is not an opinion. That is the repeating pattern of every commodity market in recorded history. Now let us talk about gold and the single most important structural force in that market right now. Since 2022, central banks around the world have been purchasing gold at rates not seen in over 50 years. In 2025 alone, according to World Gold Council data, official sector gold purchases totaled somewhere between 850 and over 1,000 tons, depending on what figures you include from unreported channels. This represented the third consecutive year of purchases well above 1,000 tons when accounting for estimates of undisclosed buying. The buyers are not small players. China's central bank has been adding gold to its reserves every single month for well over a year. India's Reserve Bank now holds over 880 tons. Poland added more than 100 tons in 2025 alone, becoming the world's most aggressive sovereign gold buyer for the second consecutive year. Turkey, Kazakhstan, and Singapore are all active. According to a recent World Gold Council survey, approximately 43% of all central banks globally plan to increase their gold holdings in 2026. Why are sovereign nations doing this? The answer traces back to February 2022, when Western nations froze approximately $300 billion in Russian foreign exchange reserves as part of sanctions following the Ukraine invasion. That single event taught every central bank in the world a lesson that cannot be unlearned. Dollar-denominated reserves can be confiscated or weaponized by another government's policy decision. Gold cannot be frozen. Gold cannot be sanctioned. Gold held in your own vaults has no counterparty. This is why central banks are buying gold through corrections. This is why they did not stop buying when gold fell 27%. A 27% discount is not a problem for a buyer with a multi-decade horizon. It is an opportunity. Now, if you have been watching this content for a while, I want to take just a moment here because something genuinely interesting is happening across all of these markets simultaneously. What we are seeing right now in precious metals and Bitcoin has happened before, multiple times, and each time it has happened, the pattern has looked remarkably similar to what we are watching unfold today. Let me take you through 3 of the clearest historical examples. In October 2008, gold had fallen from approximately $1,000 per ounce to around $700 per ounce, a 30% decline. The financial system was genuinely collapsing. Lehman Brothers had just gone bankrupt. Markets were in free fall. The headlines on gold were almost identical to what you are reading today. Gold is not a safe haven. Gold has failed. Sell everything. Then the Federal Reserve cut rates aggressively. Real yields collapsed. The dollar weakened as stimulus flooded the system. From that low of roughly $700 in late 2008, gold climbed to approximately $1,900 per ounce by September 2011. That is a gain of around 170% in roughly 3 years. The people who sold at 700 missed one of the greatest rallies in the metal's modern history. Then consider silver in March 2020. The COVID pandemic sent markets into a historic freefall. Silver dropped from around $18 per ounce to approximately $12 per ounce in just a few weeks. A decline of over 30% in under a month. Social media was full of declarations that silver was finished. Then governments globally launched the largest coordinated stimulus program in history. Rates were cut to zero. Real yields went deeply negative. Silver moved from $12 in March 2020 to $29 by August 2020. A gain of roughly 140% in about 5 months. The people who sold at $12 watched silver nearly triple without them. And for Bitcoin, the 2022 collapse is the most instructive. Bitcoin fell from approximately $69,000 in November 2021 all the way to around $15,500 by November 2022, a decline of nearly 77%. The FTX exchange collapsed. Multiple crypto lenders failed. The narrative was overwhelming. Crypto is a scam. Bitcoin is finished. It will never recover. From that $15,500 low, Bitcoin eventually climbed back to its October 2025 all-time high, near $126,000. That is approximately a 700% gain from the bottom. The pattern is not subtle. Maximum fear, maximum negative headlines, maximum selling, followed by the turn. Then the recovery. And then, looking back, those uncomfortable moments are always where the most significant wealth transfer occurred. Not at the highs where everyone felt confident, at the lows where everyone felt certain it was over. Now, I want to be direct about something because this matters. I am not telling you that what happened in 2008, 2020, or 2022 is guaranteed to repeat now. Markets never repeat exactly. Past performance is not a guarantee of future results. Each cycle has its own unique dynamics, and the current situation involves factors that have no direct historical parallel. A new Federal Reserve chairman, the aftermath of U.S.-Iran military conflict that drove oil prices and inflation higher, a Bitcoin market now dominated by institutional ETF holders rather than retail speculators. These are new variables. But here's what history does offer, a framework for thinking. And the framework says this clearly. Sharp corrections in fundamentally sound assets, driven by predictable macro forces rather than by structural failure in the asset itself, have historically resolved over time. The question is not whether gold is broken. Gold has no counterparty risk, no balance sheet, and no management team that can fail. The question is whether the macro forces currently pressing it lower, specifically elevated real yields and a strong dollar, are permanent. And when you look at the data objectively, they are likely not. The next major market event to watch is the Federal Reserve's FOMC meeting, scheduled for July 28th and 29th, 2026. Here is why this meeting matters so much. Markets do not move on events. Markets move on surprises. Right now, markets have priced in a very specific scenario. The Fed stays hawkish, rates stay high, and maybe 1 or 2 additional hikes happen before the end of the year. That expectation is already embedded in current gold, silver, and Bitcoin prices. It is already in the dollar's strength. So if the July 29th decision matches exactly what markets expect, the most likely outcome is that nothing dramatic happens. Prices remain roughly where they are. But the interesting scenario is what happens if the data surprises. Several signals are worth monitoring between now and that meeting. The first is U.S. inflation data, specifically the CPI print expected in mid-July. If inflation comes in softer than economists are currently projecting, that directly challenges the higher-for-longer narrative. Markets will reprice immediately. Gold and silver would likely begin recovering before the FOMC meeting even takes place. The second signal is the CME FedWatch tool, which tracks the probability that markets assign to each possible rate outcome. If the probability of a September rate hike starts to fall from the current roughly 60% level, that means institutional money is already rotating its positioning. Watch the trend in that number, not just the number itself. The third signal is the US dollar index, commonly called DXY. The dollar has been near its highest level in over a year. If it begins to show any sustained weakness, that is typically one of the earliest signals that precious metals are preparing to recover. And the fourth signal is language. Not just the rate decision on July 29th, but every public comment from Fed officials between now and then. Specific phrases tend to signal shifts before they are official. Words like progress on inflation, balanced risks, or monitoring conditions carefully have historically preceded policy pivots. Listen for what is said and what is not said. None of these signals require you to predict the future. They require you to pay close attention to the present. There is one more thing I want to address before we close today, and it is the most important one. Every major correction in financial history has felt permanent while it was happening. In September 2008, serious, intelligent economists were debating whether capitalism itself would survive. In March 2020, the genuine question being asked by market professionals was whether global supply chains could ever fully function again. In November 2022, with FTX collapsed and multiple crypto companies in bankruptcy, the question was whether digital assets had any future at all. And in every single case, those fears were real. They were not irrational. They were based on observable, devastating facts on the ground. The fear was completely understandable, and in every single case, those fears marked the approximate bottom, or were very close to it. This is not because markets always recover immediately. Sometimes recovery takes months, sometimes longer, and sometimes individual companies or assets do fail permanently. Not everything recovers. The difference matters. But when the underlying demand drivers are intact, when the structural reasons for an asset to hold value remain in place, when the decline is driven by a predictable and historically temporary macro force rather than by fundamental deterioration in the asset itself, history has been remarkably consistent about what eventually comes next. Gold is sitting roughly 27% below a historic all-time high, in the middle of a documented ongoing sovereign purchasing program by central banks around the world. Silver is trading near $59 per ounce, while the Silver Institute, the industry's primary research authority, projects the sixth consecutive year of global supply deficit. Bitcoin is trading around $60,000, down approximately 50% from its peak, in a market where the underlying protocol is functioning correctly, no major exchange has collapsed, and institutional infrastructure has actually expanded. These are the current facts. They are genuinely uncomfortable to sit with when prices are falling, but they are also the exact circumstances that, looking back across every prior cycle, have historically preceded recovery phases. The question to ask yourself right now is not whether things might go lower from here. They might. Predicting short-term price movements is something nobody does reliably. The question is, what is your time horizon, and what does the evidence actually say about assets with these kinds of fundamental characteristics after corrections of this magnitude? The people who built the most significant positions in any asset cycle in history did not build them when everything felt safe and confident and the news was positive. They built them in moments that felt like this one, uncertain, uncomfortable, and full of reasons to do nothing. I am not telling you what to do. That is not what this conversation is about. Everyone's financial situation is different. Everyone's risk tolerance is different. Everyone's time horizon is different. Those decisions belong to you, with your own research and ideally with proper professional guidance. What I am telling you is this. Understanding the mechanism that caused a crash and separating it from the structural case for an asset is the single most powerful tool any investor can develop. Because when you can look at a falling price and ask not just how much did it fall, but rather why did it fall, you start seeing markets the way serious long-term investors see them. The mechanism here is the Fed, higher rates, stronger dollar, real yields pressing on non-yielding assets. That mechanism is temporary. It has reversed in every single prior cycle. The structural fundamentals, sovereign buying of gold at historic rates, a sixth consecutive silver supply deficit, Bitcoin's 4-year cycle pattern, are not reversing. They are continuing underneath the surface noise. Before I let you go today, I want to ask you one final question, and I genuinely want to hear your answer in the comments. When you see a major asset down 25 or 50% from its peak, what is your instinct? Does it make you want to sell, to wait, to research further, or to look for opportunity? There is no right or wrong answer, but your answer tells you a lot about your investor psychology, and your investor psychology shapes your long-term results more than almost any other factor. Leave your answer below. I read every comment, and the discussion there is often more valuable than the video itself. If this breakdown helped you think more clearly about what is happening right now, please share it with one person who you think needs to hear it. Not because of the numbers, but because of the framework. The ability to think through a crash without emotion is a skill, and skills can be passed on. Stay curious, stay analytical, and take care of yourself and your financial future with the same patience and rigor you would apply to anything else that matters. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.